The average price of gas is just below $4 a gallon, obviously high. However, our next guest says now is still a good time to look at automotive stocks. Jonas is the head of global auto research for Morgan Stanley. Adam, why would it be a good time now?
Well, we think auto stocks are investment-grade equities, not necessarily because of $4 gasoline, but more in spite of $4 gasoline, especially compared to the last time we were at this level just 3 years ago. And the whole concept is there's never been a wider gap between the fuel economy of vehicles that are on the road right now, which we estimate are around 17 or 18 miles per gallon at best, versus the vehicle that you can buy in a new car dealership, which in many cases there's many offerings above 35 and even above 40 miles per gallon. So your average driver could reasonably save $1,000 a year by purchasing a new vehicle.
If they feel confident enough and have the money to make the purchase in the first place, right? I mean, that's a pretty big assumption. It
is, and that's a very good point, and that's another reason why I think the industry holds up much better this time. We're talking about car sales that are still at around 30-year lows, okay, at around the 13 million SAR level. 30-year low in car sales, much higher quality of consumer as well, a much lower subprime component, much better credit statistics in terms of loan losses and delinquencies compared to the last time gasoline hit $4 a gallon.
And I'm looking at your report here that came out yesterday, and it got a fair amount of attention because it seems counterintuitive to be recommending auto stocks given the price. But you say that Ford and GM, they've got pretty big upside because of their change in offering. So just because they're offering more fuel-efficient cars and smaller cars, you like those two stocks?
Yeah, it's a combination of both the big transformation in the type of vehicles that they now offer at the dealers. Their financial condition obviously can kind of weather the storm better. They've lowered their break-even point so they can handle the lower level of volume. And also, importantly, pricing is able to go some way to offset the mix degradation that they're going to feel. Rule of thumb is a 1% increase in pricing can offset a 6% shift in vehicle mix from truck to car. And they're going to be relying on that price increases to do that. That's also in part because of used vehicle prices are also setting new records every month. So that helps the credit strength of the new car buyer when they turn in their used vehicle.
But you're also, alongside those American automakers, you're also taking a look at BorgWarner, JCI. You think they're benefiting?
Absolutely. And so Borg and JCI, these are the companies, the suppliers that really supply the intellectual property that help make vehicles more fuel efficient. So they're the reasons why the manufacturers like Ford and GM can offer that more fuel efficient vehicle. And every couple months that goes by, we're seeing even more developments in the market. So GM will start introducing a line of Buicks with e-assist. The Cruise Eco is just out now, gets 42 miles per gallon. Obviously, Ford's been getting a lot of attention with its EcoBoost. A lot of that content comes from the likes of BorgWarner, and that's going to continue.
Is there, though, a point of pain for the consumer where you would turn around this thesis? I mean, if we go to $5 a gallon, obviously not the exact moment in time, but if we went there, would that make you no longer recommend these stocks?
No, there's certainly a breaking point, Margaret. Don't know when that is. I would suspect it probably would be somewhere near $5 a gallon, but it wouldn't be directly negative for the auto manufacturers. It would more be indirect. So that breaking point, we think, would be one where it would just hurt the overall economy, the jobs picture, where it would hurt the stock market, real estate, wealth effect. When we start having double dip type conversations, it doesn't matter what kind of cars you're offering in the dealership. If the economy is double dipping, these autos are going to be vulnerable. But that's more of a secondary impact. Okay,
so maybe after June we'll start to have some of those conversations, according to some economists. Others say we're on the climb for the near future. But a number of economists are scratching their heads today when we saw that CPI figure come out and a read of where pricing is. And it looked like for autos that there was about a 4% price increase there. Where is that coming from?
It's coming from demand that is just outstripping supply of vehicles. Inventories are below 50 days supply in North America. Typical would be about 60, 65 days. But that masks really the underlying, the hotter selling vehicles, passenger cars and crossovers are at 30 days or less. So really there's a shortage of the vehicles that consumers want right now, and that's contributing to this, this very healthy pricing environment.
So it has nothing to do with Japan?
Oh, it certainly has to do with Japan as well. That's one of the impacts. But even before the Japanese tragedy, vehicle supply was relatively tight. It's certainly been exacerbated by the Japanese supply disruption, and that's probably going to get a little worse before it gets better.
All right. And Jonas, thanks so much for explaining an interesting note that you published there yesterday.